Hello everyone, welcome to the video. We're going over my TFSA stock portfolio. For the week ending, we are up 3% or 169.14. Going down to the portfolio and what we actually own. Cash on hand, 1962. We have HMAX, the Hamilton Canadian Financial Yield Maximizer. We have 100 shares. We are up 1.69%. Our yield on cost is $14.80. Canadian Net REIT, it is 145 right now. We are up 3.81% on 100 shares at $5.25. PIMCO Dynamic Income Fund, we have it at $17.80. We're up 0.17%. And TGIF, the SoFi Weekly Income Fund, we are down 0.03%. We have 9 shares at $94.50, ended the day at $94.45. So, that's my holdings. I want to show you guys proof. This is my broker, all that fun jazz. I'm going to refresh it so you guys can literally look at it once it wants to actually refresh. There you go. So, there's everything. And now we're going to do a deep dive into each of the holdings. So, right off the bat, we're going to do TGIF. Thank God it's Friday. I'm just going to call it TG for now on because the name is a pretty big mouthful. So, why did I invest in this? Very simply, right above, get paid weekly. With the SoFi Weekly Income Fund, Income ETF, TGIF is an actively managed ETF that seeks to provide weekly income by investing in investment grade and high-yield fixed income securities, bonds. It expects to distribute income on Fridays. And it goes right here, get paid on Friday. Obviously, sometimes it's not a Friday. Or, like, you know, a holiday or anything like that. Diversified with over 100 bonds. It has 175, I believe. It doesn't say on here, but I believe it says in the ETF fact, which we can literally just go to really quick. Right there, 175 for holdings, and this is as of end of last year. So overall, it's doing okay. You know, it has a really, the NAV, the stock price has been kind of all over the place if we go to it. It did IPO at $100, so technically you are down right now. It also randomly does this at night. If it actually gets down 3%, I'm gonna buy a whole ton. So it's down quite a lot. IPO'd at $100. It went all the way up to 107 at one point, and then just straight down to 93.33, and then ever since then it's just hovered back and forth and back and forth. I don't expect this thing to like really go anywhere. It's literally a bond ETF, so bonds, you know, they're relatively flat. They're not that interesting. Very few people actually want to buy it. Looking at this, this is a chart that shows when it has traded at a premium and when it has traded at a discount. So for 2022, it was almost 50-50. And in this year, it's like almost entirely traded at a discount so far. So, you know, it's okay. It's Ford, Credit Suisse. I believe this is now like null. Like this thing has been nuked. Apparently it's still active. I thought they weren't paying bondholders, but I might be incorrect. I don't know, guys. AirCap Holdings, it is a variable rate, so sadly we don't know what this thing even is. Owl Rock, it has a 4.75% yield. Trust and Cleaning Corp, the 144A, oh my god, that's a long name. 3.375% maturity, callable, that at 100. I don't really understand like this entire thing. I'm relatively meh to bonds. US Bancorp, yield of 3.75. NMI Holdings Inc. has a 7.38% yield, and it expires in June of 2025. Barcay Place, it's a variable rate. It expires in 2026. Royal Bank of Scotland, it has a variable rate. I believe right now it is 6%. I believe that's what these means. When it gets like longer like this, I legit have no idea what this means. I'm just guessing. So, you know, take it with a grain of salt. Market price and NAV return is almost like on par, which, you know, it's pretty nice to see. Year to date, 2%, 2.45%, 1 month, 0.45, 0.76. It's basically all this, and in 1 year, you're down quite a lot. Or not down very much, but for a bond fund, that's pretty scary to see. So, can this sustain the dividends? I'm all about, I want to look at your income and cash flow. Can you sustain it? Directly above me, we're going to be looking at the net investment income or loss, and the unrealized gain loss on investments. If you guys really want to, feel free to go over it. I'm not going to, just because I'm more care for the cash flow, the income, and then divide that off the dividend. Everyone's different. If you want to add it, by all means, feel free. The payout ratio then would have exceeded 100%, but due to the fact, I believe this is them selling shares, they managed to get a decent amount, and a net decrease at the end of the year. So you have all that. Summary of share transactions as followed: shares redeemed, variable fees, net increase. So because of this, basically they pretty much gained profit, and if you guys can see above me, the NAV actually increased. So, you know, good to see the NAV increasing consistently, but I want to care about the income. So, how do you do this, Ken? Well, if you bring up calculator, and if it doesn't tell you directly, you can go off the dividends. So 341,250 divided by the net income, which is this guy right here. So I want to make sure you guys can see it. So 427,925. Oh, come on, really? Sorry, guys. 341,250 divided by 427,925. 427,925 equals a 79.74% payout ratio. Now, income funds, there's some rules they need to follow, and I believe, of course, it's not going to show it on here. And TGIF is no different. So if you go into it, you'll see, man, they're pretty damn consistent. You know, every week, it's pretty nice to see, I'm not going to lie, but this is overall a gimmick fund. Again, I'm using it just to buy penny stocks and stuff with it that I've had my eyes on for a while. But if you scroll down, you're going to see these large distributions in December. Since IPO, actually. So let's scroll in a bit. So, December of last year, they paid $1.27. Why did they do that? Let's go down. December of 2021, they paid $1.49. Huh, that's really weird. Let's keep going down. December of 2020, there were 2 news. They didn't pay anything. So for 2 consecutive years, they've paid us a special dividend. Why? Well, it's the same reason why they increased the dividend. They're paying, like, they're keeping too much. They have to give us a certain amount every single year, and they were unable to do it, thus they issued a special dividend. Or at least their normal dividend plus, like, significantly more, like $1.20. $1.23, you know, and then the 7 cents is just your normal 7 cents. So, overall, that's pretty much why I'm in it. I'm mostly in it just to have some exposure to bonds, relatively safety, cash and other. I'm assuming other could be anything. I'll dig into it a bit later. But overall, I'm very happy with it. It's performed about on par with what I expect. I don't really know if this is on par with the treasuries or anything like that. But buying it way down here, I know the yield says 4.54. The only reason it says that is because they're including the special dividends, where if we go to my Google Doc, I am not including it at all. But if I did, I would just do simply this. I do that, and then I just do, like, you know, $2.73 plus, or I guess I'd do that after. We do that, and that. So technically, and again, this is, well, okay, let's just say, I don't know, $1.15. Technically, it's over 4%, but I'm assuming it won't pay a special dividend, and if it does, well, I'll be very surprised, and I'll be happy at the same time. But I'm not getting my hopes up. even though they have consistently done it, because they did hike the dividend, this is the first entire year they're going to have this increased distribution. So I don't have my hopes up, but we'll see. Hopefully I'll be pleasantly surprised. But that's TGIF. PIMCO has a UNII report, which obviously, sadly, it's going to be stupid and won't let me bring it up. This is the undistributed net investment income. What the hell does that mean, Ken? Well, very simply, if the UNII is at 100%, the amount of income they make completely covers the distribution. If it is less than that, surprise, surprise, you're not making a lot, my guy. So, let's go over the UNI. And I'm sorry because you guys can't see this. So, if you guys do open the UNI report, which is that Excel thing right above me, right by prospect, scroll down and you'll find it. PDI is on 26. So, this is current fiscal year, ends in June of this year. The estimated fiscal year-to-date net investment income, NII, is $1.35 a share. Then, estimated 3 months average net investment income for the PDI, 0.0753. And we keep going over. 3-month rolling coverage ratio of 34. The 6 months of 37. And the fiscal year-to-date distribution coverage ratio is 72.3.31. So, what you can do, going back to a calculator, is you take 100. Oh, shit, it won't let me now. Take 100, subtract what it showed me. So that was 72.31. 72.31 equals plus 100. Payout ratio for PIMCO for this year is 127.69. Nice. Now, again, that is a little scary, but you can also go down to 4, and they should talk about it. So we want to go to 4. Fiscal year-to-date distribution coverage ratio is calculated on the fiscal year-to-date basis using cumulative dividends per share for common preferred, if applicable, blah, 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 blah. The numerical is the calculative NII per share, and the denominator is the distribution per share. Cumulative NII and that is deferred loss, deferred, blah, 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 blah. So, this is scary. It has 127% payout ratio as of right now. So, why? Why own it? Why would you bother owning this thing? Well, PDI last year made more money than they did, so they paid out a special distribution. Now, CEFs like PDI, GOF, CLM, HYLD, that's an ETF, but you get my point, pay out an excessive amount, normally, in ROC, return of capital. PIMCO last year didn't because it made so much money. So they didn't have to give ROC. They could have just used, their net investment income to cover the dividend, which they did. So, going at this, seeing about a 27% ROC, I'm not worried at all. That's actually a lot less than like GOF, for example, CLM, HYLD, all those other ones. It's significantly less, so I'm not worried about it. So, that's PIMCO. Now, PIMCO holds a whole ton of stuff, which we can see right here. So, sector allocation, U.S. government, mortgages, non-agency mortgages, agency mortgage-backed securities, CMBS, high-yield credit, non-U.S. developed emerging markets, investment grade, municipal, other, net short-term. Most of their stuff does still expire in 0 to 1 years, and because they bought a lot of their stuff before this year, they lost a crap ton of money on this. So the NAV has been absolutely obliterated, and it's also gone straight down to where it is now. As you guys can see, $17.99, or sorry, this is as of the 10th. $17.99 was the market price, and in $17.28, which is a new all-time low, is the NAV. So going at this, calculated that. So just breaks it all down here. Dynamic income from the NAV, MOP 11. So this goes all the way down. So it shows you this. So the high versus low, it was 22.47. Now it's 17.20. High and low. High of 23.20, and now it's 17.83. Which again, that does not include today. So the total leverage efficient duration years is 3.9. Assets in million, it has $4.4 billion of net assets. And it just breaks everything down here. So total leverage, 41.9. Most of that is in reverse repurchase agreements, credit default swaps, and all that fun stuff. Overall, I'm not too panicked or worried or anything like that. But I'm just going to sit back, enjoy it, and that's pretty much it. So yeah. HMAX is the final ETF. So this one has a yield currently, as of close of last time, 14.97%. This is high income. It says right here, 75% exposure to the big 6 banks. This is BMO, Canadian, BMO, BNS, CM, Royal Bank, TD, and the National Bank. And it currently coverage ratio of 50% for their covered call strategies, reduced volatility, blue chip financials. It does also not use leverage, which is very nice to see. So they break it down. So NAV is 1501, which is awesome. That basically means, hey, I got a pretty nice discount. Goes down here. You guys can see the Royal Bank, TD, BMO, BNS, Brookfield, Canadian, Imperial Bank, Manulife, Sun Life, National Bank, and Intact Financial. And it goes everything all over here. Assets is 220.1 million. Current annualized yield, distributions, rebalance, management fee, risk, medium. Sub-advisors, Horizon ETF Management. Auditor, KPMG, which apparently is pretty damn good. So, there's nothing too much to go about it. I don't believe they have a financial report yet. No, they do not. I'm still waiting on that. But overall, this is pretty much what it is. Many covered calls, right options on 30 to 50% out of the money. HMAX is able to achieve it because it does 50% at the money. So, overall, if it's flat, it's really good. If the bank stocks go down, it's even better. But if they go up, it's basically going to lose money. And that's pretty much it. Overall, I'm pretty damn excited about HMAX. It's like one of the very few Hamilton ETFs I actually enjoy. So yeah, we'll see what happens. Finally, the only single stock I own, Canadian Net REIT. 101 properties, $303 million of total assets, 100% occupancy, distributions of 34.5 cents, square feet of GLA of $1.46 million. Now, I want to talk about this one for a little bit. Number one, if I scroll down, which I can't do, so I'm just going to hide myself. Latest news. Canadian Net REIT announces executive leadership change. The CEO is leaving for someone that has also been with the REIT for a long period of time. Normally, that would freak people out. However, I'm relatively confident they'll be able to, withstand any issues that come out. And, no offense to the old CEO. You guys been in there for quite a while. He's done a fantastic job, but I think the REIT will do just fine without him. Breaks it down here. Quebec, 60.8. Ontario, 25. NS, Nova Scotia, 13. Breaks it all down. National, regional, local. Retail, 60%. QSR, quick service restaurant. This is like your Tim Horton or gas stations. 14.8. Service station and corner store, 20. Other, 2.8. Distributions have increased at a fantastic rate if we go to it really quick. I can't type apparently tonight. There you go. Last distribution was very disappointing, 0.59. But if we go on, 13, 17, 15, 10, and then they went from quarterly to monthly in 2018. So this apparently is a cut, even though it's not. But yeah, overall, I'm very happy with how it's been doing. You know, Canadian Net REIT, it's one of my favorite REITs. Yes, the debt is very scary on it to assets and everything like that. It's very high. But I'm excited, honestly. So this is a portfolio. The average yield, the portfolio yield on cost is 10.76%. Every single month, that is a 0.9% gain. Most of that coming from PIMCO and HMAX, and then everything else is just barely adding to it. Monthly distributions of $49.84. Literally, I can buy one share of Y Tesla or YTSL. Boom, I'm over 50. So I'm probably going to do that. Technically $19. All-time gain, this does include cash for some reason. So without the cash, it's 0.88%. And that's pretty much it. So yeah, honestly, I'm happy with it. And I hope you guys are too. I'm curious to see where we're going to go. Do you guys agree with my decisions? Do you disagree with my decisions? Let me know down in the comments. I know TGIF is going to be a hot debate because it's literally, again, a gimmick fund. But since I can use it to buy, you know, penny stocks I've been looking at for a while that I'm kind of iffy on, a really good example. So if we look at it, it's this bottom one right here. It brings in, on a week, sorry, I had something on my tongue. On a weekly basis, it brings in 72 cents. If I really want to, which I kind of do, I can use it to buy something like Marwest, which extremely low yield, but I want it because it has very low payout ratio, it is only residential, and it's down huge right now. So every week, instead of me, you know, going out of my way and being like, oh, well, I gotta do this and this and this, I can buy shares very slowly with it, which I consider better than me just, you know, here's a whole ton of money, let's see what happens. And it's hit it before, and it hasn't really gone above like 70 cents anyway, so I could technically, you know, every Friday go in and buy some now, if I really wanted to. Or if I wanted something higher yield, I could buy i3 Energy, Canadian Oil and Gas, with a 10% yield that pays a monthly distribution. Or I could buy Newport Exploration, which is even cheaper, and it's down even more today, yielding over 17% once this thing updates. It's just stuff like that that I can go over and over and over with it. Obviously, I'm losing quite a lot, but ultimately I think it's going to be worth it in the long run, but we'll see what happens. So I am very heavy in bonds right now. Technically, PDI is also bonds as well, but it's mostly loans, which is why I tagged it as such. So once I get TGIF, buy one more share, I'm just not going to touch it, and I'll move on. We'll start buying some more aggressive, high-yield ETFs, CEFs, and stocks. So we'll start going for, you know, Allied Property, YTSL, just not the whole time, just to test it out, and then all this stuff. And in the meantime, all this stuff can drip into higher yielding or dividend growth stocks. So, you know, for now, that's the plan. I hope you guys enjoy this video. See y'all in a bit. Bye!